The following podcast was recorded on Tuesday, July 23rd, 2024, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our market commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim answers the question, is the economy surging again? Jim, the most interesting question heading into the Fed meeting next week is whether the U.S. economy is picking up. What's happening with the June economic data?
The June economic data, which started to come out with the payroll report, has been looking surprisingly good. And the numbers have been picking up, rather handsomely, well above expectations. So let's go through a couple of charts to show you what we're talking about. And the first chart is the Bloomberg Surprise Index. That's on the top, and then a 5-day change on the bottom. Now, a surprise index, if you're not familiar with it, it looks at an economic release. What is the median estimate by a survey of Wall Street versus what did it actually come in at? If it's above the estimate, it gets positive net weighting. If it's below, it gets negative weighting. So if you're above zero, that means you're doing better than expected. Below zero, worse. And the trend matters. Are you getting better or are you getting worse? Takeaway with this chart is, yes, those numbers had been declining for several months down to multi-year lows, the surprise index. But in the last week to 10 days, it has turned higher. And as I show on the 5-day change, it's had its best 5 days in 3 years. And that's largely because the data that's been feeding into this has been beating the payroll report, the durable goods report, factory utilization, the retail sales report, just to name a few, have been doing a lot better than expected. You can see this in the next chart too, just kind of same thing here. This is the Atlanta Fed GDP now estimate for second quarter. We're recording 2 days before the number comes out on the 25th of July. And right now the estimate is for 2.7%. Now, if you look at the chart closely, on July 5th, it was at 1.5. So it's jumped from 1.5 to 2.7 in the last 3 weeks, largely because June data came out, and that June data on balance has been better, and it's been upping the forecast. Remember now, the Atlanta Fed GDP, my old metaphor is it's like taking your marathon time at 10 miles, what's your average mile split, and just projecting out what your finish time is. And so that's what we're finding out, is that when you add in the June data, the economy seems to be getting a lot better as well. And then the final chart here in this sequence is the Dallas Fed Weekly Economic Index. So the Dallas Fed has put together some using weekly and daily data like Johnson Red Book initial claims, weekly consumer confidence reports, and the like an estimate of what is like weekly GDP. Now, I don't want to get too hung up on the scale. Is it 2.7 or 1.4 or something like that? But I think what's more important about this data is the trend. And that's why the gray line on the chart shows you the actual week-to-week data. And the blue line is a 4-week average. And the red line is a 13-week or rolling 1 quarter average. And both the blue line and the red line are at the highest level since 2022. And they've been moving up smartly in the last couple of weeks. So again, the data is, when June came and the data started coming in for June, the April data was weak, the May data wasn't as bad, but the June data seems to be coming in better. And finally, I'll give you my favorite anecdote, the last chart. This is the TSA throughput at the airport. And I've always liked to say, the reason I like to look at this report is travel is the ultimate discretionary item. No one needs to get on a plane and go somewhere. Everybody wants to get on a plane and go somewhere. And in order for you to want to do it, you have to recognize you're going to spend, especially if you're a family, you're going to spend thousands of dollars to do it. And you're confident enough to spend that money to go on a flight. Well, this is a rolling 21-day average, so I kind of smoothed it out a little bit more than the normal rolling 7-day average. It's at the highest it's ever been. Now, of course, the data only goes back to 2019, but all the estimates are that 2019 peak in August of 2019 was the all-time high. We're above that right now. So people are not afraid to do the ultimate discretionary spending, travel, and the airports are packed because we're doing this discretionary travel, and it's consistent with what we've seen with the rest of the data, that somehow the data picked up a little bit in May and it really picked up a lot in June.
Jim, how is the bond market responding to all of this data?
Well, it's kind of caught in the cross currents here. So if we go to the next chart, here's the 10-year yield. That plunge down in the 10-year yield on the left of the chart on July 11th was the reaction to the negative 0.1 June CPI report that surprised everybody, becoming much weaker than expected. Oh, that's it, done deal, the Fed's gonna cut rates. Well, after that immediate response, the bond market didn't do a whole lot of anything for the next couple of days. And then starting around the middle of last week, it moved up from 414 to its high on Monday, the 22nd, at 428. So the bond market has been creeping a little bit higher on this idea that the data might be surprising to the upside. And again, you could argue, I argue, that actually the most important data is inflation data. And if the economic data is going to stay strong, that's demand for stuff, and that should keep the inflation data elevated or a little bit sticky. And you're starting to see that a little bit in the bond market, maybe questioning whether or not yields will continue to move lower, largely because of the strong data that we've seen.
And how about the Fed outlook?
So if we go to the final chart, this is the probability of a rate cut over the next 4 meetings. The red line is the July 31st meeting, which is 1 week from tomorrow, the day we're recording, July 31st, is a week from tomorrow. It's got a 4% chance or 3% chance the Fed's going to cut rates. In other words, they're not going to cut rates at that meeting. What they might do is they might give you some language or some signaling that it will come in September. Well, the market's already at 96% for September. So there's a strong probability in the market's mind, Fed's going to cut in September, and that's largely priced in. So you can also look at this chart as a caveat. Okay, the data's strong. Bond market may be questioning it, but not the Fed fund futures traders. Fed's going to cut the rate. Fed's going to pull the trigger and cut rates in September. That, unless, of course, we continue to see strong data. Now, you could ask the question, well, wait a minute, it's at 96%. Can it go all the way back to zero by September 18th? And the answer I would give you is, yeah, it can. Doesn't mean it will. You know, if you look back in January, we got to an 81% chance or 82% chance that the Fed was going to cut rates in March. The data came in strong. That dwindled to zero by the March meeting. In April, we got into the mid 80s, like 84, 85% chance that the Fed was going to cut rates at the June meeting. Data continued to frustrate by staying strong. That dwindled to zero by the June meeting. It doesn't mean that the 96% has to dwindle to zero, but I wouldn't look at it and go, oh, done deal. Fed's going to cut rates. Move on. Let's talk about something else. Just pencil, in fact, write it in ink. The Fed's going to cut rates in September. It's not quite the done deal. If this June data continues, then July data continues, and if you see any kind of firmness in the inflation data, I wouldn't be surprised if that orange line starts to go down and suggest that there might be some rethink. Now, of course, the caveat I gave you here is if the data stays strong and the inflation data firms, which is what I think actually might happen. But if I'm wrong on that and it doesn't happen, then it's going to stay up here, you know, in the high 90% range. So the takeaway here is, as the calendar turned into June, and now that we're in July and getting the June data, it definitely looks like the economy is surging back. Now, none of this is a leading indicator. All right, it's surging back and the data's been good and June has been good. That means July doesn't mean anything for July. but it does mean that it is stronger than we expected. And it does mean that it has been surprising at a time when we've been talking about slowdowns and we've been talking about the need for the Fed to cut. This data is going in the wrong direction. It's not enough yet to frustrate the whole idea of a Fed cut. It is enough to maybe have the bond market start scratching its head even after that CPI number, not be able to follow through on it in the weeks after the CPI number. And we'll have to see where we're going. But bear in mind, the data has turned better in the month of June, and we'll see how it goes as we progress through the rest of the summer.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks everyone for joining, and have a great day.